I can shut this down by simply buying the real put. Let's take a look at how this works. The covered call is going to make us money via the decay of the extrinsic value of our short option. Day by day, this thing decays. That is where we're really, truly trying to capture our profit. The intrinsic value of the stock offsets any intrinsic value gain of the option. You might say, well, Ron, I understand, but as the stock starts to trade up, my at-the-money call starts becoming in the money. And now that it's in the money, it has intrinsic value. And I'm in trouble because now I'm not just losing extrinsic value that I could have collected, I'm losing intrinsic value. You own the stock. You own the Mac Daddy of intrinsic value. The stock is intrinsic value. It's pure intrinsic value. So by owning the stock in a 1-to-1 ratio with selling the calls, you have an intrinsic value offset. No matter how much intrinsic value the call can gain as the stock goes up, the stock's already got it all. Eventually, the call will start gaining intrinsic value 1-for-1 with the stock, but it'll never exceed it. So whatever advantage your stock had on the get-go, that advantage will remain. So you don't have to worry about the call losing more money on the way up than the stock is making. It never will. The stock will always come out making more money via intrinsic value than the call will. Now, the extrinsic value we collect, that premium that we collect every month, different people look at it different ways. Some people say, hey, I made an extra $2 this month because I sold calls. Okay, that's fine. You can look at it as if you just had additional profit. Well, hey, you know what? By selling my calls, I just lowered my entry price. You know what? That's right. The guy who bought the stock at 30, sold the call for 2, he's now in at an effective price of 28. He lowered his total investment in his initiating price. He's lowered it by the amount of premium that he brought in when he sold the call. You can look at it that way. You can see it as a way of lowering your initial investment cost. Some people want to look at it as a hedge. Hey, you know what? Thank God I sold that call and brought that $2 in because my stock was down $2 this month and I didn't lose a penny. All three of these are equally correct. It doesn't matter what you're looking at or how you're doing it. All three of these are the same thing, said in different ways. The gain in extrinsic value collection, that decay that you brought in, can be looked at in any one of these three ways. Now, here we have the ability to sell the in the money, the at the money, or the out of the money. And we know which one we want to sell. We know we want to sell the at the money option, the one in red. It's got the most premium in it, and it's going to decay the fastest. However, there is a couple things you want to know about selling the in the money instead, or selling the out of the money instead. If we sold the in the money option, we're going to lower our break even. We're going to have more. Why? Because we're not just selling extrinsic value, we're now selling intrinsic value also. Not something we want to do on a regular basis. But there is a little point in time where we might want to do that. Not often, but every once in a while. And I'll explain that to you in a little bit. If we look at this green line, well, heck, our break even is pretty ugly there. But we can sell that out of the money option on occasion. It's not bringing in all that much money, so it's not really protecting us to the downside that much. But there is a time where selling the out of the money is the right choice. We just need to know when. Again, you're going to be selling the at-the-money option just about all the time. However, there will be an occasion to sell an in-the-money option. There will be an occasion to sell the out-of-the-money option. So why are we going to use covered calls? This is probably the biggest reason. And for those people who are retired with a big stock portfolio and you don't want to sit there and replace all your stock positions with long-term option positions, all right, you should, but if you don't want to, you don't want to. Let's then use the covered call strategy to generate income. Let's use that portfolio as a nest egg, as our principal, and let's generate income from it. How do we do it? We sell calls against it. We generate income from the covered call strategy. We're generating income from our long stock positions. We could also profit from stagnation. A lot of times you own a stock, doggone thing goes sideways, especially those big blue chips. Well, if it's going sideways, what we might need to do is figure out how to make the thing make us money. Stock goes sideways, it's not making us money. However, if it is going sideways, we have the ability to sell calls against it. That will generate income in, thus enhancing the performance of that blue chip stock that's just trading sideways for months, potentially years at a time. This is a big one. Increase the probability of profit. See, when we buy a stock, pretty much only one way we make money. If we buy a stock, it's got to go up. If it stays still, we lose commission costs. We lose that bid-ask spread that we had to pay to get in and, of course, out. And we also lose opportunity cost. We bought a stock that isn't moving. So if it doesn't move, it's not good for us. If the stock goes down, then that's outright bad for us. So when we buy a stock, there's only 1 out of 3 potential things that can happen, which are good for us. However, when we sell the call against the stock, we still have the ability to profit from the upside. We're still bullish. Covered call strategy is still long delta. The difference is, what if the stock is unchanged? If the stock is unchanged, the guy who just buys the stock, well, he's got nothing. He's actually lost a little. But the person who sold the call is going to collect the entire amount of premium from selling the call. That means they're going to have a profitable month now. The stock might not have made anything, but the call did. And it's even profitable sometimes if the stock trades down a little. Because remember, your break even from the premium that you're bringing in, your break even is located below the stock. If the stock trades down, say $1, but you brought in $2 from the sale of your call, for the month, you're still going to have made $1. You lost $1 in the stock, but you made $2 selling the call. So when you look at the probability of profit here, when you do the covered call, you can make money when the stock goes up. You can make money when the stock stays still. You can even potentially make some money if the stock trades down, provided it doesn't trade down more than the amount of premium you brought in that month. The only way you get hurt is if the stock trades down more than that. More ways to win now, more ways to profit, higher probability of success in making money using the covered call strategy. Why? You might have trouble seeing this chart right here. But the fact of the matter is we know that whenever we buy a stock, we put a bell curve directly over that stock price to give us an idea of potential range of the stock for that given period of time. Now, if you look closely here, the green line is straight stock. The red line is our covered call position. Look at how the covered call functions versus the stock in the first standard deviation, where 70% of the time the stock's going to be right in this area right here. If you notice, with the stock unchanged or even down a bit, the covered call makes money, even where the stock loses. On the way up, still staying in that first standard deviation, the covered call outperforms the stock. It isn't until we get out to the second standard deviation where the stock overtakes the covered call's profitability. What is the percentage chance of that happening? It's not that high. So very rarely do you own a stock and say to yourself, I think this thing's going to run beyond what the covered call strategy would do for me. Because 70% of the time, the covered call is definitely going to be a better strategy than owning the stock outright. That is just simple, basic probability. Higher probability of profit in the range where the stock is most likely to stay. Now, covered call strategy is a great strategy at the right time. You can't say, hey, I'm going to do the covered call strategy for this month. No, we know that the covered call strategy needs repetitiveness. It needs to build commission versus commission versus commission. You've got to constantly bring in that premium month after month after month after month. So when we're anticipating a longer term, slower grinding uptrend, that is a perfect time to employ the covered call strategy. We need to make sure that we're not trying to throw this on a short-term, quick-moving stock. That is not what the covered call strategy is made for. This is made for, hey, I just bought Exxon and I'm going to hold it for 20 years. Covered call strategy. Oh, I just bought IBM and I'm going to give it to my son in 5 years when he graduates college. Covered call strategy. Oh, wow, this stock's breaking out and it could run up 20% in the next 3 days. Not the covered call strategy. You've got to put the right strategy onto the right opportunity. Covered call strategy is best used when you're anticipating a longer term grinding uptrend. Now, what's it good for? For those blue chip stocks that we're going to hold in our portfolio for 1,000,000 years that just aren't performing. They're just sitting there. They're not moving. They're not doing anything. What can we do? Well, we can sell them out if we want and try to find something else. Fine. Or we can leave them there, let them be stable, and then sell calls against them, bringing in premium every single month, month after month after month, for years. That's how we jumpstart the performance of these blue chip stocks, the ones that seem always dead in the water. We can also use it when we're looking to generate income. We get older, we have to start drawing down on our IRA to pay for everything that we're doing. Instead of drawing down on the principal, let's leave the principal intact, sell calls against the stocks we own, and generate income instead of drawing down on principal. Remember, you draw down for long enough, at a good enough size, you will run out of money. We want to try to avoid drawing down on our principal. We want to try to generate income off of our principal. And the covered call is a real good strategy to use when we have a positive put call skew. Instead of running out and selling the put, let's buy the stock and sell the call. The call trading at a higher volatility level than the corresponding put. That is how we take advantage of put call skew. We talked about this when we talked about synthetic positions. This is a synthetic position. The covered call strategy is actually a synthetic short put. If the call is trading at a higher volatility level than its corresponding put, and you wanted to sell the put, instead buy the stock and sell the call. You just did sell the put at a higher volatility level, meaning you sold it for a higher price. So now let's take a look at what type of charting pattern we can describe as a long-term uptrend that has characteristics. The long-term uptrend has specific characteristics, and you need to know what those characteristics are to know that you're in a long-term uptrend.
Very, very good.
Well, thank you.
I commend you. That was an excellent job.
I appreciate that. But guess what? It's your turn. You're up.
Okay.
So now that everybody has a good idea of the actual mechanism, the foundations of the covered call strategy, it's time for them to figure out, or actually be taught, how to find that long, slow grinding uptrend that the covered call strategy is perfect for. And that means technical analysis, and that's your world.
Technical analysis. That's my bag, baby.
That is your world.
All right. I'm going to show a couple of basic technical analysis studies, how they can identify the trend line when it's a breakout, and then follow through with a slow grinding uptrend, which is ideal for selling covered calls.
Perfect.
You ready?
I am ready.
Okay, good. I'm out of here. I'll see you in a little while.
I'll be here.
So to initiate a covered call strategy, the best chart that you can hope for is a slow grinding uptrend. Hopefully it's an intermediate to a long-term slow grinding uptrend. I'll show you how to identify an uptrend right here. So you can see that the stock bottoms out in March and starts to move higher, and it moves higher for about 3 months. It moves higher in this tight little channel here, and the bottom line in this channel is called the uptrend. The top is the channel line. Now this is not an official uptrend until this resistance level right here is broken. What happens is the stock bottoms out, you connect the next low with this trend line that you see on the bottom right here, but it's not an official uptrend until this highlighted part happens, until this resistance point right here in red is penetrated to the upside. That's when it becomes an uptrend. At that point, you want to wait to see if you have some confirmation of this uptrend. If you're a little bit more aggressive, then you might take some bullish positions right here. But if you're not that aggressive and you're like me, you want to wait for a little bit more confirmation in the trend before you act on it. You wait until it revisits the trend. You wait until it revisits the uptrend line right here, and you also study the volume activity. Now you can see the green bars indicate an up day, and the red bars down here indicate when we had a down day. So it's very easy to see up volume versus down volume. And it's pretty clear that this stock's under accumulation because you can see that the up volume is larger than the down volume. And what that tells you is that when the stock moves up, it's because there is an overwhelming amount of buying as opposed to nobody selling. So what happens is the stock moves higher in this channel, seems to find even highs that you can draw a line, a diagonal line across the top of and connect. When the stock moves back down to this trend line again, that's the best time to take a bullish position. And you can see that the stock immediately popped up, found some resistance right here again. When it found that resistance, that might be the ideal time to sell a covered call against your bullish position.
Check out how Ron matches options to Chris's analysis. We've got a bonus video online for you now.
Welcome back.
Well, thank you.
Very good. Thank you for showing everybody actually the easy way of finding a slow grinding uptrend. It's perfect.
Did I do a good job?
And I thought you did a very good job.
Does my hair look okay?
It's definitely gray, but it definitely looked okay. But now that they can find these slow grinding uptrends, and they now put on their covered call strategy, it's time to talk about what we're going to do with that strategy as the stock starts to move, as volatility moves, as time passes.
Right.
Because you know, it's one thing to identify the opportunity. Then you apply the strategy, but eventually you actually have to manage the position. And at some point in time, we know that long, slow grinding uptrend will come to an end, and we're going to have to make some type of adjustment.
Well, as we know, when the stock moves, the stock continues higher in this case. There are a lot of different variables that go into the price of an option, and those variables tend to change when the stock moves, right? That's what we're talking about, adjusting when those things happen.
And sometimes they actually change when the stock doesn't move.
Because of time passing, because of volatility changing.
Volatility and time work independently of the stock, and that's one of the things that I think that people coming from the stock market have such a hard time with. They don't understand that there's 3 independent variables that affect option prices, whereas in the stock market, that underlying stock,
supply and demand.
Yeah. I mean, there might be 50 million reasons why supply and demand are affected, but ultimately, more demand, less supply, stocks going up. More supply, less demand, stocks going down. But in the options market, it's a lot different. It's got to do with 3 different things, each having a considerable effect independently.
There's always an ideal strategy or an ideal adjustment depending on how those variables change.
That's exactly right. And if you know them ahead of time, then when it comes time to make that move, you'll be more confident because you've already planned it out and you're already prepared for those inevitabilities.
Okay.
So let me go show everybody how to do that.
Go for it.
I'm out of here.
Okay, then.
Well, let's take a look at the setup of the covered call strategy. The first thing we have to do is we have to buy the shares of stock in 100-lot shares. Reason being is because, remember, our calls are going to be worth 100 shares each. We have to make sure we're in a 1-to-1 ratio. So keep in mind that we want to buy our shares of stock 100 at a time, 100 at a clip. And then what are we going to do? We're going to sell the calls. 1 call per every 100 shares. There's our 1-to-1 ratio. Which call are we going to sell? We're going to sell the front month at the money call. Or we could sell the front month slightly out of the money call, because there is a potential that the stock might be located between 2 strikes. The strike above is the one that we're probably going to want to sell. It'll have the same amount of extrinsic value as the one below, but the nice thing is the one above will not have any intrinsic value, and we want to kind of stay away from selling intrinsic value, at least under most conditions. There is one little condition where that might not be true. We want to sell that front month call consistently, month after month after month. Don't take any breaks every month. No vacations every month. Don't tell me, oh, well, vol's not real high this month. Every month. Remember, when you sell a high volatility month, you've got a lot more potential to collect. But the problem is the probability of collecting it is lower. So what does that do for your expected value? In a month where volatility is low, you might not collect as much, but you stand a much better chance of collecting that. Where's the probability there? Month after month, we sell that option. Now let's take a look at an example of the covered call selling the at-the-money option. We're going to buy the stock at $60. We're going to sell the call for $4. What is our maximum gain here? $4. What's our break even? Well, our break even, the rule, the formula, is what? The stock price minus the call price. 60 minus 4, break even of 56. What's our maximum potential loss? Break even down to 0, 56. Now, what if we sold an out-of-the-money call? Let's buy the stock at 60 and sell the 65 calls for $2. Our maximum gain is what? In the call, $2. The maximum gain of the position, though, is different. Why? Because the stock could run up to 65. The call would net us $2 in premium brought in, but we have room for capital appreciation. But think about how big of a movement that is. $5 on a $60 stock in 1 month. Where do you think that lies on our bell curve in terms of probability? Our break even is 58. We don't have as much downside protection here. 60, the stock price, minus the call price of $2, 58. And what's our maximum loss? Well, break even down to 0, $58 is our maximum loss. Let's take a look at an in-the-money example. Buy the stock at 60. Let's sell the 55 call, obviously in the money, because its strike price is lower than the stock price, right? We sell the 55s at $7. What's our maximum potential gain? $2. What's our break even? 60, the stock price, minus the call price, total of 53. Our break even is 53. Why? Because we not only have the extrinsic value providing some protection for us, but we also have $5 of intrinsic value providing protection for us. This might be a good thing to sell when we're still in the range, but we're at the top of the range around expiration, and we're expecting the stock to stay in the trend, but drop off a bit, give us more downside protection. The out-of-the-money option that we just did gave us room for capital appreciation. Maybe we might do that during an expiration cycle where we're down near support and we're expecting the stock to stay in the trend and bounce up off of support. Gives us more room for the stock to run. What's our maximum loss here? 53. Break even to 0, 53. So what are the keys to success? I mean, what are the major bullet points that are going to make me a successful buy writer or covered call writer? On the floor, the term is buy right. Solid technical and fundamental analysis of the stock. That is always true. The fact is, I don't want to throw a covered call strategy on a stock that's about to break out. And I sure as heck don't want to throw a covered call strategy on a stock that's going to go down, whether slow and grinding or fast and aggressive. I don't want to be putting the wrong strategy and fitting it onto the wrong opportunity. You gotta sell the calls consistently every month. Month to month, every month. You've got to be selling these calls. Basically, what we're working on here is the power of compounding. Every month, bringing in that premium. That premium builds and builds and builds on itself. That is what we're trying to accomplish here. Buy back that short option when most of the extrinsic value is gone. You don't have to wait for the last penny of it to come out on expiration day. Don't be greedy. Just when you're short that call to capture extrinsic value. When most of it's gone and there's only maybe 20, 30 cents left, move to the next one. We can buy back the one and sell another one. And if we do that in the same month, and that does happen, we might have a month where we get to collect 2 premiums. Hey, don't worry about buying back your short option at a loss. It simply means that you've maxed out your strategy's potential for the month. I love when I have to buy back my short call in the covered call strategy at a loss, because that means I made the most amount of money that month that I could have in this strategy. You need to be able to get past, I got to pay 4 for the call I sold at 2. Congratulations. You just don't understand that you don't get the gist of this position. It's a premium collection position, not a stock directional position. So let's take a look at trading this thing. Now that we have it on, what if the stock goes up? What are we going to do? Well, there is a potential roll. We might want to roll it vertically if it's a quick movement. We might possibly want to go ahead and create a horizontal or diagonal roll at expiration. It depends on where the stock is come expiration. What about some potential morphs? No, the stock's doing what we want it to do. Why do I want to change this strategy when the stock is doing what we want it to do? What about closing alternatives? Well, I don't want to close something that's working. I want to keep it open. I want to keep it rolling. I want to keep it moving. So let's just concentrate on the rolls when we're successful. Remember, we roll positions that are working. We morph positions that don't. So here we are in our covered call strategy. If the stock starts to trade up, this option that was at the money will become in the money. And when it becomes in the money, it might start collecting intrinsic value, but it's going to be losing extrinsic value. Buy it back. The intrinsic value that this option is building, which is short intrinsic value, is covered by your long shares. Meanwhile, the extrinsic value has basically disappeared. Buy that call back, sell the next option that has big extrinsic value. Collect another premium. Heck, do it again. When this goes in the money, the extrinsic value disappears, and we get to roll this option. Now, what happens if the stock goes down? The first thing we need to do is determine what we mean by down. If the stock is still in its uptrend, maybe it was at the top of its uptrend, and it's just trading down, still inside of its uptrend, we can roll down. The problem is if the stock has fallen and it's broken the uptrend, where we have violated this uptrend, we're no longer in the uptrend, then we're in the wrong position. So you have to make a determination as to whether this downward movement of the stock is a movement, just a little fluctuation in the trend, or if it's a breaking of the uptrend. If it's a breaking of the uptrend, different story. If it is just a simple downturn inside the uptrend, maybe the stock trading down off the tippy top of its range, then we can talk about potentially rolling it down and collecting more premium. If, by chance, it's not just a simple sell-off inside the uptrend, and it's now a violation of that uptrend, breaking the uptrend, we have to look at morphing the position. Because now, if it breaks the uptrend, it's now actually a breakdown. And we can't be in the covered call strategy in a stock that's breaking down. We do have an alternative. We do have the ability to close the position. If we feel that, hey, I don't know, the stock's heading down and I'm not feeling comfortable about this, you can always close the position out. Now, here's the beauty. Understanding our knowledge of synthetics, what can we do? We can actually not buy the call back and sell the stock out. It's two trades. We can simply just buy the real put. Why? Synthetically, this position, the covered call position, is synthetically equivalent to a short put. All we have to do is buy the real put and place ourselves into a conversion that'll shut the trade down. So let's take a look at what happens when we're trying to roll this position. The first situation we talked about was, what if the stock was heading down, but it's still in the uptrend? What can we do? We said that if it's still in the uptrend, we can roll down on this position. We could buy back our 65s. They'll be very cheap now, right? Because now they'll be out of the money. We could buy them back and sell the 60s, which may be the new at-the-money option. We can do this. We can roll down as long as we're still in the uptrend. If we're not in the uptrend, then what we need to do is turn this thing into something else. We need to morph it. And the easiest thing for us to do is add this put. All you have to think about is go to the strike where your short call is and buy the next strike put. So here we are in the 65 strike covered call. We're at the 65 strike. Go to the next strike up, the 70 strike, and buy that put. What does that do? Well, remember, our long stock and our short call combine to create a short put. Synthetically, we are short the 65 put. If we buy the 70 put, we have now put ourselves into a vertical spread, a bear spread. We're going to be long the 70 put, short the 65 put synthetically from our covered call. So as the stock now breaks down, we're in a bear spread and in a much better position to trade this downward movement in the stock. We're only going to morph it into this bear spread if the stock breaks down, if it breaks the trend. If it stays in the trend, we'll roll the call down, break the trend, buy the next higher strikes put, and boom, we are in a put spread, a bear put spread, and we're going to get a chance to actually make money on the breakdown. Remember, we can always close it. We can always just say, hey, you know what? I'm not liking this. I want out. So what do? We buy the put of the corresponding call. So if we're short the 65 call, we buy the 65 put. When we buy the 65 put, we create a conversion. Long stock, long put, short call. In one trade, we shut down our covered call by simply buying a put. Why? Because the covered call is like being short the put. Buy the real put, nullifies each other, we've shut the position down. Not too hard. The idea of morphing and closing is trying to do the most with the least. Save time, effort, and energy. Don't make it difficult. Save some commission, save some bid-ask spread, but get us out of the wrong position and into the right position quickly and efficiently. What if the stock stays still? Here I am in my covered call, and the stock stays still. Well, as long as the stock stays still, month after month after month, I'm going to keep doing this covered call strategy. It's what I want. Remember, ultimately, the covered call strategy is a premium collection strategy. If the stock stays still for me and becomes stagnant, beautiful. I'll continue to sell calls month after month after month from here to eternity. I don't care. I'm collecting the premium every month. So what are we looking to look at? A vertical roll out. When do we do it? Normally, the day or two right before expiration. If the stock's not going to move, we can wait till the last second before we have to roll out. The longer we can stay in it, the more premium we collect, because the most premium comes out of that option in the last 2 days. Quite often I find myself, when in a covered call position, back in the day before I learned about options, what I would do is I'd wait to 10 of 4 on Friday of expiration. Then I do my roll. That's provided that we're in a situation where the stock is staying still, maintaining a stable level. What about morphs? Why would we want to morph this? This position's working perfectly. Don't change it. The stock is going sideways. That works here. The covered call strategy is great for a stock that goes sideways. Leave it alone. No morph here. And we definitely don't want to close it. Why would we want to close a position that is doing exactly what we want it to do, in the exact way we want it done, and we're making money? Stay with it. Continue to just roll it out. Continue the position. So let's take a look at that. Here I am in my covered call strategy. The expiration of June is fast approaching. This option is decaying rapidly. The stock is right here at 65. The day of expiration, 3:45. I hop on my computer, bring up my platform, and what do? I buy back my June 65s and now sell my July 65s. Done. Now I am in my July covered call. And I can keep this going month after month for as long as that stock stays right there. So that's about it with the covered call. Now, there are some intricacies with this strategy that some more advanced traders might be able to exploit, and we'll get into that at some other time. But the covered call is a great strategy for those of you that have stock positions that aren't performing, or for those of you that have a portfolio that you're about to start drawing down on. Don't draw down on your principal. Use that principal to generate income using the covered call strategy.
Well, that was a great job, Ron. Real good. Covered calls. So the next thing that we're going to cover is covered puts. But before we go on to covered puts, I want you to go back to the website, optionsgps.com, and first go to the community, talk to your peers, take the quiz, make sure you pass the quiz before you move on, and then we're going to move on to covered puts. So I'll see you on the next DVD.
Okay, in Chris's example for an opportunity to place a covered call, he picked United Technologies, UTX. Now, in the covered call strategy, we know that this is a strategy that has a delta. We're going to be long, but it also is a premium collector. So we are looking for an upward movement, but we don't want an aggressive upward movement. We want that long, slow, grinding staircase of a trending movement. So let's take a look at what we would do if we decided to take Chris's advice and try this with United Technologies. First thing is, we've got to look and find where the stock is. And what I'm going to do here is I am going to go and show you where we find the stock. Right there. See under last, 45.94. That is the stock price, the last trade of United Technologies Group. We also want to look at the strike price, because as a premium collector, we have a specific month and strike we're supposed to sell, right? We're supposed to sell the front month, and we're supposed to sell the at-the-money. With the stock at 45.94, there's our at-the-money call, the 45 strike. We also know that we need to sell the front month. Where's today's date? Right here, April 2nd. That makes our front month the Aprils. So I am showing you that we do practice what we preach here at optionsgps.com. We are going to sell the front month at the money. So we take a look at our April 45 calls here. 205 bid, offered at $2.15. So there is our option of choice to sell. Obviously, being investors, not market makers, we're going to have to sell on that bid. We sell for $2.05. Now, it's important for you to note that that $2.05 is not purely extrinsic value. Remember, the at-the-money strike can be slightly in the money or it can be slightly out of the money. When it's slightly in the money, like it is right now, we will have an option that has some intrinsic value. We have to make sure we know this. With the stock at 45.94, the 45 strike's going to have 94 cents of intrinsic value. That is the type of value that does not decay. We need to capture extrinsic value. All we need to do is take the price at which we sold the call, 205, subtract 94 cents, and that is the amount of extrinsic value that we have in the option. Now, when we make that sale, we know that our option is going to have roughly $1 of extrinsic value, and we're going to see about $1's worth of decay between now and expiration in April. What do we want to happen? We would like to see this stock stay here or continue up at a very slow, grinding pace. That is the secret behind the covered call. Now remember, we have to sell this every month. Can't just do it here in April. We've got to sell it in May. We've got to sell it in June. We've got to sell it in July, August, September, October, November. You know the calendar as well as I do. This is a repetitive strategy. We're going to be rolling this short call out constantly over a long period of time, collecting that decaying extrinsic value. If we get a little boost in the stock and we get a little help from that side of things, fine. But you've got to really focus in on the fact that the covered call strategy is really a premium collector first, directional second, because this short option will cap any type of stock gains we get. So the real power behind this strategy is the collection of premium consistently over time.